I am a certified financial planner and the founder of Ametrine Wealth. I've been in the wealth management industry for over 17 years and have been fortunate enough to be quoted in several articles and countless publications on personal finance and investing. I offer comprehensive financial planning and investment management services for individuals, couples, and families with 500,000 or more in investable assets. And I have a specialization in working with those who have employee stock compensation, RSUs, stock options, etc. I'm also super grateful to have Logan Holman here with me. She'll be moderating the Q&A section. Logan is a CPA and co-founder of Vivify. She is a really great tax accountant. We have several mutual clients together. And as I get into the presentation, you'll see that it's really key to have a great tax accountant on your team. So Logan, thank you for being here. So we'll talk about what RSUs are, how they work. We'll spend a bit of time understanding the tax piece because you don't want to get yourself in trouble if you screw up on the taxes. And then we'll talk a little bit about leveraging your vested shares to build wealth and managing risk, ending with Q&A. So I will do the presentation in 30 minutes. I know some of you may need to leave right at the end of 30 minutes, but anyone who is able to stay for the Q&A section will have time to answer plenty of questions as well. Okay, before we get into it, I would love for anyone to share in the chat box. Has anyone sold any RSUs? I know some people may be new to getting RSUs. Some of you may have had RSUs for a long time. So type in the chat if you've ever sold RSUs. And also, if you have any questions, of course, again, we'll have time for questions as they arise. You can type them in the chat box and during the Q&A section. But if there's any burning questions you have that you want to type in the chat box, go ahead now and you can enter your questions. RSUs can be a substantial, can become a substantial portion of your net worth, really helping people build their wealth. So it's important to understand them and manage the risk that comes with RSUs and understand what to do with the proceeds, what to do with them. So first, just let's get into the basics. Restricted stock units are a form of equity compensation that companies grant to employees as part of their pay. So they represent shares of the company that vest over time. So when you get a grant of RSUs, you do not own the shares immediately. You start owning the shares over time as they vest. There is no purchase required to become an owner of company stock if you get RSU grants, and the value of your shares is going to depend on the stock price of the company stock. So companies often grant employees a specific number of shares of RSUs annually for those who qualify as an ongoing incentive to stay with the company. And you may get additional grants from time to time specific to you or the company's policies. I often see people get sign-on bonus grants, and there might be other occasions where companies give additional grants like promotions, or if the company is working on some major initiative and wants to make sure that they retain their top talent until they complete the initiative. Okay, so let's talk about vesting. There are two main types of vesting schedules, and each grant has its own vesting schedule. It's important to understand that companies may use multiple different types of vesting schedules depending on the grant. So you want to know what the vesting schedule is for each individual grant. And the two main types are graded vesting, where you get the shares gradually over time, and cliff vesting, where all of the shares vest at once after a certain amount of time. So here's just an example of graded vesting. This specific example is 4-year graded vesting with annual vesting. So you don't own any shares until the end of year 1, at which point you own 25% of the shares, and so forth until finally at the end of year 4, you own 100% of the shares. Now, again, I said that this example is 4-year graded. There might be a 3-year or 2-year or some other number of years of vesting, and shares may vest annually, they may vest quarterly. I think I've even seen monthly vesting. So it's going to be unique to, your company's policies, what they typically do, but also the specific grant. And then here we have an example of 3-year cliff vesting. So you don't own any shares at the end of year 1, no shares at the end of year 3, and then, at the end of year 2. And then finally, at the end of year 3, that's when all of your shares vest. Again, the specific example is 3-year cliff vesting, but there might be another period of time for the cliff vesting schedule. So when the shares vest, that's when they become your shares. Now, typically, if you part from the company, or always when you part from the company, the vested shares remain yours. Typically, any unvested shares go away when you leave the company. So if you decide to get another job, then you're probably going to lose all of the unvested shares. Depending on your company or your specific situation, they may allow you to keep unvested shares for them to continue vesting. For something like if you're retiring, it might be part of a severance agreement or at death or disability. But in general, any unvested shares go away when you part from the company. So the value of your shares vesting is equal to the number of shares vesting times the current market price of the stock. So value equals vesting shares times current market price, and that becomes taxable income on the day that the shares vest. So here's an example. You have 100 RSUs of ABC company. They're fully vested today, yay. The current price of the stock is $100 per share. So you have 100 shares times $100 per share. Your grant vests at $10,000, and as of today, you have $10,000 of earned income. Okay, now we're going to get into the tax piece. So the first taxable event of RSUs is when the shares vest. They are taxed as ordinary income upon vesting. So they're subject to federal and state taxes at your marginal rate. And because it's earned income, they're subject to payroll taxes, meaning Social Security and Medicare taxes. So usually what happens is when your shares vest, your company will automatically sell a certain number of your shares to be withheld for taxes. State taxes, the withholding is going to vary by state. Typically, if you live in a state with a flat tax rate, like I live in Michigan, we have a flat 4.25% state tax rate. Typically, you could expect that state taxes in Michigan on RSUs are going to be withheld at 4.25%. And if you're unsure what the withholding's at, you can always do the calculation from your pay stub where you get the RSUs. Shares are also often sold to cover any applicable Social Security taxes at 6.2% if you have not earned enough yet in the calendar year to no longer be subject to Social Security taxes, and of course Medicare taxes at 1.45%. Federal taxes, this is where it gets fun. So employers typically withhold federal taxes at 22%. So this can be a huge problem if you are in a tax bracket that is above 22%. If you're in the 22% tax bracket or lower, you should likely be fine. But if you are in, say, the 35% federal tax bracket, then you're going to owe another 13% in federal taxes on your grant. And this is what trips so many people up, because they would think that if they're withholding taxes, they're going to withhold the right amount. And unfortunately, that's just not how it works. A big reason being that your employer doesn't understand your full income situation. If you're married, if you have investment income, those types of things. So they just follow IRS guidelines and most often withhold RSU taxes at 22%. This is the same for bonus income and other types of, extra income that you might get beyond your salary. So it's really key to have a great tax accountant. Send them your RSU pay stub so that they can keep you, keep appraised of how much you might owe in additional taxes. You will likely maybe need to start making estimated tax payments or increase your withholding on your salary so that you don't end up owing a huge amount, or at the very least, just making sure that you don't have a huge tax surprise. That if you're going to owe, say, $10,000 when you go to file, that you know that well ahead of time so you're not shocked and scrambling for the money. Okay, the second taxable event is when you sell your shares. Selling your shares means realizing a capital gain or loss if the market price of the stock is below the price of the stock at vesting. So it's important to understand that when you sell your shares, you only have to pay taxes on the difference between the current market price of the stock and the price at vesting. That's as if it's a gain. Of course, you do not owe taxes if you sell at a loss. So price sold minus vesting price times the number of shares. We have an example here where you sell your vested RSUs at $105 per share. They vested at $100 per share. You have 2,000 shares that you sold, so you have just realized a $10,000 capital gain. Now, it's important to understand long-term capital gains versus short-term capital gains. So shares being held for at least one full year, and for this, I mean 1 full year since they vested, they are taxed at a lower preferential rate for federal purposes. So the top tax rate, federal tax rate on long-term capital gains is 20% versus the normal tax brackets, the top rate is 37%. So there's 3 possible rates depending on what tax bracket you are in, either 0%, 50, 15%, or 20%. Short-term capital gains, those are gains on shares that you've held since vesting for less than 1 year, and they are taxed at ordinary income. So if you're in the 24% tax bracket and you realize a short-term gain, the difference between the price that you sold at and the price that the shares vested at, that's going to be taxed at 24%. Now, it's really important to understand that when you sell shares, there's no taxes withheld. So if you are realizing tens of thousands or even, 100,000 plus in capital gains, which may or may not make sense given your individual situation, it's really important to keep your tax accountant apprised of this because, again, you want to make sure that you don't end up with a tax surprise, make any adjustments to your withholding, or make estimated payments because these are taxable events where 0 tax is going to be withheld. Okay, so there's 2 big RSU mistakes regarding taxes. The first one I've already talked about a little bit, annual tax surprise. So often when I start working with clients for the first time and they have RSUs, I ask them a little bit about their taxes and they say, oh my gosh, Carla, every time I go to file my taxes in April, I hold my breath and just wait to hear what my tax accountant or TurboTax tells me how much I owe. It makes me so nervous. And it does not have to be this way, okay? You want to, again, have a really great tax accountant on your team or a financial advisor that can at least help you understand the additional amounts of taxes that you may owe. Now, best case is with this tax surprise, you owe a huge amount of money and okay, that stinks. You weren't expecting that, but you just take the money out of your bank account. I've seen worse situations where where people have this big tax surprise and they don't have the money. Maybe they sold all of their RSUs at vesting and they spent all the money. Or maybe they kept the money invested in the stock after it vested, but the stock has tanked in price. And so now they need to pay, I don't know, say $15,000 in federal taxes, and their vested RSUs are only worth $5,000. They need to find somewhere else to come up with the rest of that money. Okay, the other big tax mistake is missing the safe harbor rule and having to pay penalties. So it really stings to have a big tax surprise, but at the end of the day, you owe what you owe in terms of taxes, but penalties can definitely be avoided. So a lot of people don't know this. If you do not withhold or pay enough in taxes during the actual tax year, then you're going to owe penalty. And as I said, most people that are getting RSUs are high earners, so they are often in a tax bracket higher than 22%, or I know many people that are starting to get RSUs and they're in the 22% tax bracket now, so they're usually good when it comes to tax withholding, but I warn them that as your income continues to grow, this is going to likely become an issue. And I'm going to get into, so let's talk about what the safe harbor rules are. Okay, so you need to have withheld at least 90% of the taxes that you owe during the current tax year. So if you owe, say, just making up numbers here, $100,000 in federal taxes in a year, that would be quite a lot, but I've seen that. You need to have withheld at least $90,000 during the actual tax year, either through probably a combination of payroll withholding and maybe some estimated tax payments. Or you need to have withheld 110% of your previous year's taxes. So many high earners don't realize that they're being under withheld for RSUs. And again, they get the big tax surprise, and then also sometimes they end up having to pay these penalties, which can definitely be avoided. Let's look at an example. So I wanted to give this example because what I see is many times people that start getting RSUs, they're getting promoted, they're getting bumps in pay, their RSUs are growing in value, and their income is increasing substantially from year to year, which is wonderful in so many ways. And they end up getting safe harbored without even realizing it. And then what happens is they have a much lower income year because, let's face it, the economy is cyclical. So the economy might be booming, and then either the company itself or the market as a whole may not be doing well. And so bonuses are cut, RSUs have lost value, and so they've been increasingly earning more and more until one year they have, a down year, and they're not automatically safe harbored by having withheld 110% of the previous year's taxes. So here's an example. Year one, moderate income year, you owe $50,000 in federal taxes. So for next year, in year two, you need to have withheld lesser of either 90% of the current year's taxes or $55,000. 110% of year one taxes. Okay, so we go from owing $50,000 in federal taxes in year one to owing $100,000 in year two. Yay, you got a big raise. You got lots of RSUs vesting at high value. Awesome. So you may still owe a big tax surprise if you're not working with a tax accountant to understand how much you may owe, but you're probably going to be safe harbored. You're probably going to have at least $55,000 withheld just through your regular paycheck, plus the 22% being taken out of your RSUs and bonuses. And then here we get to year three, where you have a lower income year. You're just, unless you're making insane estimated payments, you would not be withholding, you would not have withheld at least $110,000, 110% of year two. And it's likely that you may not have 90% of that current year's taxes withheld if you're in the higher than 22% tax bracket, again, because people are typically under withheld on their RSUs and bonuses. So the takeaway is that past coverage may have been accidental thanks to rising income, but if income drops and you don't adjust your withholding or make estimated payments, you may end up owing penalties. Okay, that's that on the taxes. Again, at the end, if you guys have questions, I'll open it up. Let's talk a little bit about leveraging your RSUs, divesting, and reducing risk. So first, I want to talk about the huge inherent risk that there is to holding company stock. So number one, I'm a huge believer in diversification. So not putting all of your eggs in one basket. Super risky to have a substantial amount of your net worth into one single stock. And that risk becomes even larger when that huge concentrated stock position you own is the company that you work for. So even if you work for a highly established, huge company that you would think would never go under, we have seen crazier things happen. Or even if the company doesn't go under, it could have some major dips. I started in this industry in 2008, which was a very interesting year. And, you know, we saw so many companies go under forever that year that no one ever thought would have happened. So when you have that huge concentrated position in your portfolio, that's your company stock, if your company goes under, or even, you know, something big happens and they really go, they're having a really bad year or two, the value of your stock is going to majorly drop, if not go to zero. And what happens when companies don't do well? They tend to have huge layoffs. So your livelihood is at risk too. There's just so much tied to employer stock. So when people ask me, you know, what do you think about the market now? Have you done analysis on my company? Do you think I should still sell my RSUs? I say, I don't believe in market timing. I can't predict what's going to happen to your company's stock or any single company's stock. It's not about that. It's about reducing risk. Professional investors diversify, so should you. We want to protect your financial future because you just have too much to lose. Okay, so your shares vest. What do you do? You're probably not surprised. I recommend that you sell your shares upon vesting or as soon as you're allowed to, taking into account company blackout periods. A lot of companies will allow you to, ahead of vesting, direct them to sell all the shares upon vesting. So you'll sell those shares exactly at the vesting price, which means zero capital gains. If you do not have the ability to do that, you can likely go in and sell the shares pretty soon. And, you know, if you're selling them manually, it's unlikely that you'll sell it at exactly the vesting price because the market's always changing, but you're probably going to sell it a little bit above or a little bit below the market price. And so little to no capital gains taxes, not a big deal. So you sell your shares, set aside a portion of the proceeds for future taxes due. You can either maybe estimate the taxes yourself. I would probably more so advise that you talk to your tax accountant. And then with the remainder of the proceeds, go ahead and invest that money in a diversified portfolio so that the money continues to grow and it's not just sitting in cash. How to divest of RSUs. So this is a more complex topic, and I wanted to keep this webinar pretty short, but just I'll give you a couple of tips. So, you know, I come across a lot of people that they've been working for the same company for years and years. They never knew what to do with their shares, or their colleagues told them, oh, hang on to the stock, it always goes up. So you may have tens of thousands, if not hundreds of thousands of RSUs that are already vested, and the price has gone up substantially. So if you sold everything now, you'd be having to pay huge capital gains. So what do you do? Number one, going forward, sell the shares as they vest. So that's step number one, that going forward, just sell the shares as they vest. That way you're not continuing to build this very concentrated position of company stock. Now, again, for the shares that you've already held, here's just a couple of pointers because we don't have the time to get really in depth. And it's also very specific to each person's situation. So what I would recommend doing is log into your company's stock page and look at each lot, each vested grant, and understand what the unrealized gains are for each lot. If there are any shares currently at a loss, I would go ahead and sell those. A lot of us have bias where, you want to wait to sell until the shares reach value. Well, I'm not telling you to sell at a loss and just keep the money in cash. Sell it at a loss, take the tax loss, get that money into a diversified portfolio. I don't know what's going to happen to your company stock in the future, but I do strongly believe that the stock market as a whole is going to continue to go up over the long term. The US stock market as a whole, on average, returns about 10% a year. Now, that is, of course, not 10%, 10%, 10% year after year. It's going to be all over the place in the short term, but if we can zoom out and look at the big picture, you can double your money roughly every 7 years by being invested in the US market as a whole. Okay, so sell any shares currently at a loss, and then if you do realize a net loss, maybe sell some additional lots at a gain to offset those losses so that you net zero and you're getting some you're getting out of some of that concentrated position and able to diversify. Bigger picture though, because I've worked with people that have large amounts of company stock, and I work with them to create a strategic plan to sell their remaining shares over time, really trying to balance the tax consequences in any given year while also wanting to reduce portfolio risk. So if you sell all the shares at once, you're going to have probably a huge tax bill due that year, which a lot of people don't like. If you sell the shares over many, many years, then you, of course, risk the fact that your company stock may tank before you're able to sell off all of the shares. So finding that balance, coming up with a plan and being very aware of, how much in realized gains you're going to have each year, how much you're willing to pay in taxes. And then I just wanted to quick point out that if you are charitably inclined, this is a really good opportunity to donate shares of your appreciated stock over cash. So this is really a win-win because if you itemize your deductions, you can get that charitable deduction for the market price of your stock. And whether or not you itemize your deductions, you're able to give the value of however many shares of stock you want to give at the current market price without having to sell the shares and realize those gains. So I think a lot of people don't realize that most charitable organizations accept shares, and since they're nonprofits, they don't have to worry about paying taxes on the shares that they sell. I wanted to touch briefly on 10b5-1 plans. I think someone put in the comments that they've been selling off their shares this way. So this is a preset trading plan that allows you to sell company stock on a fixed schedule. You create the schedule in advance, and this way you don't have to worry about insider trading accusations, blackout periods. You just automatically have shares sold off over time. So definitely an option to help you divest of your company shares. And in sum, sell your RSUs when they vest, set aside funds for your tax liabilities, invest the remaining proceeds in a diversified portfolio. Prioritize your financial goals, build that emergency fund if you don't have one already. Save for retirement. Saving for retirement doesn't necessarily have to be in a retirement account, right? There's brokerage accounts where you can invest and grow your money for the future. And, in general, you should be saving 10 to 20% each year of your income for long-term financial security. And again, I don't have a ton of time to touch on this point, but consider getting a customized financial plan for best results to better understand if you're on track for retirement and your other goals. How much of your RSUs can you spend and enjoy versus needing to invest for your future. So I'm a huge fan of looking at my clients' financial pictures holistically, taking all the uniqueness of their situation into account to give really clear guidance. Okay, so that's my presentation. I will now open it up to questions. Logan, I just want to point out here we have some QR codes for my Instagram account, Logan and Vivify's Instagram account. Logan cracks me up on Instagram. And of course, if you want a free consult with me, I always do free consultations, and you can also look into meeting with Logan as well at Vivify.
Yeah, definitely. And that was a great presentation, Carla. I personally will just give you a shout out too. I work with other financial advisors, and not all of them are so good at planning, especially around the taxes. And I think that that's a disservice that the other, financial advisors are doing to their clients. And I think it's super smart how you look at their whole situation, including their taxes. So kudos to you. I love working with you. I do have some questions that came through if you're ready. This one I think is fitting to go first. Is there any planning that you should do before you get RSUs? Like if I think I'm going to get a promotion next year and start getting grants, is there anything I should do?
Yeah, great question. So I think it's really good to think about, let's see, what your goals are, getting all of your ducks in a row. So I see a lot of people, often in their 30s and 40s, though other stages of life as well, where they really start getting huge increases in pay. So it's really important to think about what your goals are, wanting to enjoy some of that extra income while also making sure that you're on track. Now, if there are some great opportunities here, if you expect to be in a higher tax bracket in a future year than you are now, that might involve, rethinking, getting a lot more money into a Roth 401k or doing a Roth IRA, whether you need to do a backdoor or a regular Roth IRA, so that you can get a lot of after-tax money into the wonderful Roth shelter at a lower tax rate. And I think it's just really important to start getting your ducks in a row if you don't have an estate plan yet, as you're sort of preparing for wealth, thinking about how to grow your future wealth, protect
Mm-hmm.
your future wealth, and also finding that good balance of saving for the future and enjoying your money and not waiting till you're 90 years old to spend it.
Yes. I think that that's sometimes counterintuitive to think, oh, you actually want to recognize taxable income this year, whether that be a Roth conversion, because paying tax on it this year before you have all that other income will be lower tax than in the future. So that's a really good point. Another question was on the slide about selling RSUs, and it was just what are company blackout periods?
Oh, yeah, great point. Okay, so you need to talk to HR and see if you are subject to this. So there's definitely a certain level enough at any given company has access to insider information. So usually it's right before earnings are going to be announced publicly that insiders cannot trade. So it's called a blackout period. So any insiders, which may be directors and up, again, you want to talk to HR and make sure that you understand when you are not allowed to sell shares, because when a company's quarterly earnings are announced, the insiders, of course, know, and that's can radically change the stock price. So if the insiders know, oh yeah, our earnings was way under target, they would love to, if it were legal, they would love to offload all of their shares before the stock price tanks. So just understanding when you are and are not allowed to sell your company shares.
Okay, very good. Another one, do you see a pro or a con of clients you have, or just in general, of a graded vesting versus a cliffed vesting? Is there one that I should try to negotiate for? Can I even negotiate that?
Ooh, It's an interesting question. Um, I, I guess probably you could negotiate anything.
Yeah, I was
Anything's
gonna say,
negotiable.
yeah.
Um,
Personally, I think that I genuinely see graded vesting more. I don't know necessarily if that's right, has to be what happens, but I've never heard of someone negotiating it, but that could be interesting.
yeah. Um, Gosh, it's hard to say. I would think that probably graded vesting is better just because people switch jobs so often these days that, if you have to be there for 3 whole years, which used to be nothing, but
Hmm.
especially if it turns out you don't like the job, if you can at least get graded vesting and get, if you stay at least a year, you get a portion. But
Yeah,
my gut says there's probably more important aspects of compensation to negotiate over vesting schedules. But super
yeah.
interesting. I'll have to think on that one.
Even in general, if you're not negotiating the vesting schedule per se, just RSU grants is something that you can negotiate. You know, you go into a job and they say, oh, the salary is really set. I've seen situations where you say, okay, well, giving up XYZ stock at my current company. If I come over to you, can you guarantee? I think that
Hmm.
that is much easier for hiring managers to change or increase than just the set salary.
Yeah, for sure.
Okay, this is a personal, special question to me. And it's more of just a statement. I always get confused if my RSUs are being double taxed. How often do you hear that question, Carla?
Oh, that's interesting. I don't know that I've ever heard that, but yeah, um, I think again, the tax piece is confusing, which is why I wanted to spend a lot of time on that. So as I mentioned earlier, um, when you sell your vested RSUs, you only pay the taxes on the gain, not the whole amount. And of course, that's true with any type of security that you own. If you bought a mutual fund, and say you bought it for $10,000 and it's now worth $15,000. And I'm a big believer in buy and hold, but let's say you want to sell it for whatever reason, you're not paying taxes on that full 15,000. You're only paying taxes on the difference. And that brings me to another good point too, is I've heard a lot of people say, well, I want to hang on to my company stock for at least 1 year after it vests so that I'm paying long-term capital gains instead of short-term capital gains. And I get where people are coming from, but like I said, I'm a big believer in selling it at or close to the vesting price and
Hmm.
diversify because you never know what's going to happen in a year. And it's not just about whether the price is going to go up or down, but it's more about is the price going to, if you believe the price is going to go up, how likely is it that it's going to go up faster than the US market as a whole, right? Because I'm not saying
Hmm.
sell and keep in cash, sell and invest. So just all types of things to consider.
Yeah. And if you are selling very close to when they vested, if you're recognizing a short term gain, it's not going to be a large dollar amount because the stock hasn't fluctuated a lot since it vested. So you're not paying a super high tax on that. I always like to explain it as well to clients sometimes. So you're used to getting paid in cash. So your company pays you in cash. Now you're holding cash that you already paid tax on. You can go and buy groceries, whatever you're buying. With RSU, instead of getting a dollar given to you, right, you're getting a stock. You can't go buy anything else with that stock. So then to use it, you have to sell that stock and then you can go buy it with cash. So you're not paying double tax, you're just having two different events. I think Carla's slides
Hmm.
on that were really helpful. So if you need more explanation on that, definitely go back to her slides. Um, One that just popped up. Um, Carla, is it worth it to keep some portion of vested RSUs for a large company like Amazon with a history of an appreciating stock price?
Yeah, great question. So, um, A couple points on that. I recently actually on my Instagram a couple weeks ago did a reel with some great data provided to me by Dimensional Fund Advisors, a wonderful mutual fund company. So first off, interestingly, the 10 largest US stocks at any given point of time, once they become one of the 10 largest US stocks, they typically, historically, almost always underperform the US stock market as a whole, which makes sense because once you're a company of that size, it's really hard to get that level of continued outperformance, right? For a small company to, build their company really rapidly, and that's what kind of shoots them up into the top 10, but it's really hard to sustain that level of growth. So I think it's important to keep that in mind. The other thing I would say is, again, it's so hard to imagine anything ever bad happening to Amazon, but we have seen these types of incidents. But okay, the other thing I would point out is you're continuing to work for Amazon. You're continuing to have lots of unvested RSUs that are continuing to vest, and you're continuing to get hopefully great bonuses. So you already, even if you sell all of your vested RSUs, you still have a lot to gain from Amazon. You still have a huge vested interest in Amazon. You're still going to always be invested in Amazon stock because you have all these unvested RSUs, and even if you take all of your proceeds and invest it in a total U.S. stock market, a substantial portion of a U.S. stock market fund is going to have Amazon in it. So great question, but I still always recommend to divest of company shares as soon as you can.
All right, we are close to time. So the last thing I'll just throw out is how Carla and I work together on certain clients. So I think that it's super important that people have financial advisors like Carla. She's really good at looking at holistically and giving you investment, full balance sheet advice. And then when things get really technical with tax and you're ready to actually file the return, Carla's not going to sign that for you, but she's going to work closely with a team like Vivify to make sure that everything you both have worked so hard to execute is actually reported correctly on your tax return.
Yeah, I'm a huge fan of collaboration. So if I'm thinking about doing working with a client on Roth conversions, or a client has really high income and they want to make a large charitable donation in 1 year to offset some of that income, and they're of course charitably inclined, don't give to charity just for the tax deduction. I love to, throw these ideas around with Logan or other tax accountants that I work with and say, really help them hone in on the tax bracket and pinpoint, the best amount and what other ideas that we can throw around. Because I tend to know a lot more about my clients' entire situations.
Mm-hmm.
I think that's accurate to say, right, Logan?
Yeah, we always call the financial advisors the quarterbacks. You know it all.
Yeah, so being able to bounce ideas off of each other is, great. It's just fun, but I guess more importantly, it can be super beneficial to our clients.
Yes, totally. Well, Carla, this was wonderful. Are there any particular follow-ups or next items that you want people to consider before they leave this?
Oh gosh. Well, like I said, feel free to follow me or Logan on Instagram. I do want to point out on my website, ametrinewealth.com/insights. I have several blog posts that I've wrote over the past 2 years that relate to high earners. So I have a blog post that goes in depth on the taxation of RSUs. If anyone has company stock options, I have an article explaining that. One talking about comparing compensation packages and some other employee benefits. So feel free to check those out. Again, Logan, thank you so much. And then I also just wanted to give a shout out to Dan Corcoran, who you're not seeing on here, but he's the one that branded my slides, and I always say bedazzled them. So I just, make boring black and white slides, and he makes them look pretty. So, and so much more beyond doing that. So thanks both of you, and bye everyone.